Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. Tax Reform 2.0 to the OECD's latest developments. I'm Doug McConey, PwC's U.S. International Tax Services Leader. You can watch these podcasts on YouTube at youtube.com/Doug McConey. On this week's episode of Cross-Border Tax Talks, we're back in Westminster Studios in St. Louis, Missouri, where I'm excited to have Calum Dewar back on the podcast. Calum is an international tax partner in PwC's Washington National Tax Service Office and the leader of our integrated global structuring practice, heading our outbound, inbound, and value chain transformation teams. Calum spent the first 20 plus years of his career working in the UK. Calum, welcome back to the podcast.
Thank you for having me.
So Calum, before we begin, we're at the end of another American football season. When you came to the U.S. permanently about 10 years ago, and I am mindful we've pretty much let everybody know your age, for those astute with math on the listening to the podcast, but when you moved to New York, you adopted the New York Jets as your team and even got season tickets. I just wanted to check in. How do you feel about the Jets' 4-win season this year? Any predictions? And are you still going to hang on to the Jets as your adopted team?
Well, in my defense, I actually picked the Jets in 1993 when I came on secondment the first time.
Okay.
And they weren't quite as bad then as they are now. I mean, they weren't great, but they were as bad. I'm a firm believer. If you pick a team, you pick a team. You don't change just because someone else is better. So I'm sticking with the Jets. This season with one more win than last season.
Right.
We keep getting high draft picks. At some point, by the law of average, we'll pick someone good. I saw a report on the TV the other day said they're going to be great next season.
All right.
I think it was sponsored by the Jets, but
I'm sure it was. But I will remind you, Calum, I was a fan of a losing NFL team for a couple decades. We did have a Super Bowl here in St. Louis in '99, but I'll be honest. At this point, I would certainly take a 4-win NFL team in St. Louis than no team at all. Albeit the city of St. Louis now is $750 million less attorney's fees richer after the lawsuit that was recently settled. But
right.
At least you have a team.
Right.
Actually, a couple still in New York. Mm-hmm. All right. Well, so let's get into the topic at hand. So, Calum, the end of 2021 was a busy time for tax authorities and a busy time for those of us as advisors and tax practitioners reading hundreds of pages of releases during the last couple weeks of December. So in this podcast, we're going to talk about the Pillar 2 model rules, also referred to as the Global Anti-Base Erosion or GLOBE rules, which were released on December 20th, 2021. Mm-hmm. I'll also note we'll get to that the EU issued a directive similarly related to this a couple days later. So maybe you can just start with a little bit of the process. I know we're still waiting. We've got some detail from these rules. We're waiting for a couple of other additional pieces of guidance, and then also help us a little understand effective dates before we jump into some of the substantive proposals.
Right. So the model rules on Pillar 2, as you say, were published just before Christmas. They set out the framework of how the rules will operate, how they interact, the mechanics of the relevant parts of the calculation. The OECD Inclusive Framework had promised they would be released with some guidance notes explaining how the rules applied and giving examples, etc., as they've done with other BEPS programs before. But obviously it became clear before the release of the model rules that the guidance notes weren't going to be released at the same time. They had been promised in January. I think we're now hearing it's more likely to be February before we see guidance notes. I'm not really expecting those guidance notes to necessarily move us forward very far. They generally, give guidance by reference to black and white examples of how the rules work. And unfortunately, most of us operate in the world of grey. So the black answer or the white answer isn't actually helping us with most of our fact profiles, but we'll wait and see what they actually include. Mm-hmm. That is meant to be followed by later this year the implementation framework, which is the OECD intending to write draft legislative language for how to implement these rules, and that will be obviously very helpful. But it's worth pointing out that whatever the OECD releases isn't legislation.
Right.
It is countries that legislate, and countries can faithfully follow the OECD language, or they can depart from it, or they can have interpretations of it. So we're some ways away from knowing exactly what the rules are going to say by reference to each jurisdiction.
Right, and if prior performance is indicative of future results, what we saw from the kind of BEPS 1.0, jurisdictions took, many different jurisdictions took many different approaches to the mechanics of the rules.
I think that's right. I mean, the biggest example obviously is the hybrid rules. Those hybrid rules, largely followed similar language in implementation in a lot of jurisdictions, although some jurisdictions departed meaningfully from them. But it's actually the interpretation of the rules that generally gives to different results across jurisdictions. So we're going to have that, I think, going forward as well.
So maybe then we can move to, we have the income inclusion rule, which
maybe I'll just touch on timing as well
Please.
there, because, the OECD have set an extremely aggressive timetable with application of the income inclusion rule, which we'll come to in a minute, by 1st of January 2023, and the application of the undertax payment rule, which again we'll get into in a bit more detail, by 1st of January 2024. They are aggressive timetables by anyone's definition. The EU Directive, which you mentioned in the opening, follows a similar timetable. So again, the EU is looking for an implementation 1st of January 23 and 1st of January 24. Again, a pretty aggressive timetable. So we will see how the timetable works. That's currently the working timetable. But at the end of the day, as I said, this requires a legislative process. And for example, the UK issued a consultation document earlier this week, and they're already slipping the timetable by 3 months because the UK legislative process generally has a finance bill in February, March time. And so they're looking for a 1st of April 2023 and 1st of April 24 implementation date. So we'll see what everyone else does.
And I will remind listeners, like you have constantly reminded me, that the UK is no longer in the EU.
It's no longer in the EU.
So they will be subject to their own timetable. But just as a quick follow-up on the EU and specifically the timing there have been a couple of holdouts, right? We've heard and some comments from finance ministries, including Ireland, and I think we have Cyprus, and then we know Hungary has got a significantly lower rate of 9% compared to the minimum of 15%. Tell us a little bit about that and just some of the language that was in the beginning of the EU Directive, which implied that everybody was on board, even though not everybody seemed like they were on board.
Well, so, I mean, the first important point is an EU Directive requires unanimity amongst the 27 member states. So a directive cannot be passed without unanimous agreement by all member states, unless they change the EU law enacting that, which requires unanimous approval to change the law. So you're kind of in the same place. The EU in their directive opening language said that they fully expect that everyone will agree to this directive. They pointed out that all but one of the member states had signed up to the inclusive framework. If you recall, Ireland held out for some time, but then effectively came on board and signed the political agreement issued by the inclusive framework. Hungary did the same, albeit with some noises around transition rules, etc., etc. The one country that didn't actually sign was Cyprus, and the commentary in the EU Directive is they fully expect them to come on board. So, the EU, at least public relations rhetoric, is this will be agreed unanimously, albeit I think they've got a little bit of work to do to get everyone on board the way they want to get them on board.
Yeah, and again, kind of looking at the past again, I think many of us, when we saw BEPS 1.0, the anti-hybrid rules, the interest limitation rules, I think a number of assumed that certain jurisdictions may hold out and not be able to get unanimous consent. And obviously, we know what happened there, that everybody got in line. And there's obviously significant political pressure in each of these respective countries that it would seem reasonable to assume that everyone will get in line here.
And I think, when we get into the rule construct, you'll see why actually holding out probably doesn't do you much good at the end of the day. The taxes will be collected, and the question then becomes, well, who's going to get the tax revenue?
Right. So perfect transition. Let's move into what I think we can refer to as the IIR, which is the income inclusion rule. We've got lots of acronyms here like we do elsewhere in tax. And then the UTPR, which is the undertax payment rule. Can you talk a little bit about just the mechanics of the calculation and how does that work?
So the calculation, before we get into sort of how it gets collected, which is the IIR and the UTPR, the mechanics of the calculation, I think, are an important starting point, which is the whole aim of these rules is to identify low tax jurisdictions. And where you've identified a low tax jurisdiction, which effectively means an effective tax rate of less than 15%, the aim of the income inclusion rule and the undertax payment rule is between them to ensure that the tax that is less than 15% is topped up to 15%. That's the basic construct. We can get into a bit more detail of how you calculate an effective tax rate. But the idea is once you've done that calculation, you've identified the low tax jurisdictions, then the first rule that's meant to apply is an income inclusion rule. And that works from the top down. So you look at the ultimate parent entity. So in the context of a US multinational, that would be the US parent. In the context of a UK multinational, that would be the UK parent. And if they've implemented an income inclusion regime that is compliant with the OECD proposals, then they get to implement the top-up tax under the income inclusion regime. And the basic construct there is the ultimate parent looks at all the subsidiaries, direct or indirect, works out which jurisdictions have got a lower than 15% effective tax rate, and then levies a charge on the parent entity effectively to collect that tax.
And that's referred to as the ultimate parent entity.
That's the ultimate parent entity. Now, they've then worked out, well, obviously group structures often have intermediate holding companies all the way down. So you may have an ultimate parent entity in a jurisdiction which holds some or all of the group through an entity in another jurisdiction, et cetera, all the way down. So there's a cascading income inclusion rule. Starts off with the ultimate parent entity. If the ultimate parent entity hasn't implemented the rules, then the next holding company jurisdiction down gets to effectively collect the low tax income tax burden on the top-up tax all the way down through the chain. And there are rules for partial ownership and split ownership and all those sort of things. So the income inclusion regime, which is the primary rule within the framework, works from the top down. And then the backup to that is if the top-up tax has not been fully collected, if the top-up tax that's been calculated as owing has not been fully collected through the income inclusion regime operation, then the backup is the undertax payment rule. Now, that's a interesting approach, differs significantly from where the blueprints of earlier last year positioned it. And I think the key point here is the word payment should be ignored in the definition of an undertax payment rule, and we'll get to that in a minute. But the basic idea of the undertax payment rule is to say, if you're in a group, a multinational group, and you're a jurisdiction that's implemented these rules, if there's another low tax entity within the group, low tax jurisdiction within the group, where the top-up tax has not been collected through the income inclusion regime, you, that jurisdiction that's implemented the rules, and every other jurisdiction that's implemented the rules gets the right to collect that tax by reference to a split between the jurisdictions that have implemented based on employees and tangible fixed assets. So effectively what that's doing is saying, look, if the jurisdiction hasn't done anything itself to up the tax from low tax, and the parent jurisdictions haven't done anything to up the low tax, then the policing mechanism will be everyone else who's implemented these rules gets the right to collect that top-up tax without reference to connectivity between the activities of the jurisdictions that enacted the rules and the low tax jurisdiction. So go back to the blueprint, the idea seemed to be that if you were a high tax jurisdiction and you made a payment to the low tax jurisdiction, hence the undertax payment rule language, then that payment that went to the low tax entity could be denied, adjusted to try and get back to a sensible level of tax, an agreed level of tax. That mechanism has now been dropped, and now it's just if you are a high tax jurisdiction that's implemented the undertax payment rules into your legislation, and there's low tax profits anywhere in the group that have not been collected through the income inclusion regime, that jurisdiction get to pick up your share of that low tax income without reference to connectivity at all. And that's suggested in the paper by a mechanism where you can deny deductions, and they're not deductions that are payments to the low tax entity, they're any deductions. So right. Deductions to third parties, deductions for employee costs, deductions for anything, and or any other mechanism that gives a substantially similar result. So potentially a deemed income inclusion number as opposed to a denial of a deduction. So there's no connectivity at all. And I think that's the biggest shift in the framework from where the blueprint was to where we are now, is that by adopting that mechanism, the framework effectively says, all I need is one jurisdiction to implement these rules in relation to a multinational group structure, and I'm effectively in a position of policing the low taxed income.
Okay, so I'm going to give you an example, because this was the hardest thing for me to wrap my head around as I was going through this proposal, because I was still, to your point, so fixed on, well, where's the undertax payment? So imagine that we have a U.S. parented company, and then let's say hypothetically, and we'll get into this a little bit more later, that the U.S. does not have an IIR compliance. So let's assume that the Build Back Better dies. We don't end up with country by country, and we do not have an IIR compliant. And then let's assume that U.S. multinational operates in 3 jurisdictions. Let's say the UK, Germany, and China. Let's assume also that the UK and Germany have adopted these rules, and they're effectively paying close to the statutory rate, right? And we'll talk to some of the mechanics and deferreds and some of the complexities associated with the calculation. But so we've got kind of full rate in the UK and Germany, and then let's assume China, there's some incentive, some technology incentive, right? So that we're paying a low amount of effective rate, that the effective rate calculation results in, let's say, a 5% effective rate. Yeah. So explain to me then, so what you're saying is that the UK and Germany then could effectively impose a tax on that undertaxed amount in China.
Yeah, they can adjust the tax computation of the UK and German entities in such a way that UK and Germany between them are picking up the 10% top-up tax that would be imposed on China. Even if China is not selling or trading in any way at all with the UK and Germany.
Yeah, and intentionally didn't say there were any royalty payments, no interest payments. China's not necessarily selling to the UK or Germany. Yeah. And that rule, the income inclusion rule, is effective for January 1st, 2023.
Well, it's effective for when countries implement it. The timetable is 1st of January 2023. Fair enough.
And then the UTPR, there's still a year later than that. And
again, within the timetable.
Within the timetable. And so the issue is before that backstop rule comes in, and we'll get a little bit more to this, is that if the IIR applies and if the U.S. does not have a compliant regime, then they'll need to look at those intermediary holding companies, for example.
Yeah. And I think that maybe the next bit of the equation is the calculation of the effective tax rate, which...
And maybe we start with just the calculation in general before we get to the...
Well, the calculation in general is relatively logical. It says you've got to find the the appropriate income per entity and the appropriate amount of taxes per entity, and then the effective tax rate. Sticker alert here is the taxes divided by the income.
Right.
That's the effective tax rate.
Okay.
Now, that is then aggregated on a jurisdictional basis. So you start off at an entity basis, entity being a company, a branch, a partnership, in certain cases, hybrid entities. So each entity is done separately, but then you aggregate the results on a jurisdictional basis, which does mean that, for example, losses in one entity in a jurisdiction that are being used in a consolidation regime to offset other profits are being blended in the calculation. So there is blending, but only on a jurisdictional basis.
Right.
I think the biggest challenge in the calculation is, as a practical matter, is the calculation is being derived from data that I think in most cases does not readily exist. And that is because they've defined the income line as being the financial statement income calculated under the GAAP of the ultimate parent entity with numerous adjustments, some of which make complete sense. So they've adjusted out for dividends, they've adjusted out for participation capital gains, but then they've adjusted for other matters such as FX differences and things that go through OCI and a whole host of adjustments to the income item, which I don't think any multinational will have that data to hand. Even if they did have entity level data, which a lot of people don't keep data that way from a financial accounting perspective, they look at it consolidated or by business line or whatever. They don't generally push GAAP down to those individual entities unless it's required under local statutory accounts. And if it is required under local statutory accounts, that's normally a different GAAP than the GAAP of the parent. So there's a whole host of data mining adjustment exercises to do to get to the income number.
And that's called the adjusted net globe income.
That's the adjusted net global income, globe income. And then that is the denominator in a calculation which then has the covered taxes as the numerator. Now, covered taxes is again a very complicated calculation, which again, most of our clients won't have the data for. It starts off with the current taxes for that entity for the current year. And that's a number that I think you would be able to find, I think, in most people's accounting systems fairly easily. But because the OECD wanted to make sure that timing differences didn't skew the numbers either for or against a company, they then concluded the right way to deal with timing differences was to include the deferred tax charge or credit for the year, but with significant adjustments to the deferred tax number. And so there are requirements to change basis numbers for purposes of amortization calculations, for purposes of calculating the timing difference on amortization. There's a cap on deferred taxes on balances brought forward, where if you're in a jurisdiction like France with a 28% corporate tax rate or whatever it is, the deferred tax balance brought forward, which you would have booked at whatever the local rate was, 28%, is now capped for the purpose of this calculation at 15%. So you have to go away and find your deferred tax balances, then reverse them.
Reverse the portion of them up to the 15%.
And then there are other rules that say if you've got a deferred tax balance in relation to a liability that doesn't come due within 5 years, you may have to reverse those as well. There are a host of adjustments, some of which I'm not entirely clear I understand the rationale behind the adjustment, but all of which will require a significant compliance exercise to get those numbers. Once you've got those numbers, the tax number, the covered tax number, and the global net income number, adjusted globe income number, then you can calculate your effective tax rate. If that comes out to 12%, then you know that your top-up percentage number is 3%. There is then one further adjustment before you work out the top-up tax. So assume you had 1,000 of adjusted globe income and you had a 12% effective tax rate. You don't apply the 3% to 1,000. You apply the 3% to 1,000 minus the substance carve-out. And the substance carve-out ultimately is a rule that says you get relief from the top-up tax for 5% of your employee costs and 5% of your fixed asset cost, a tangible asset cost. There is a transitional rule which actually starts those numbers at 10 and 8% respectively, and then over 10 years gets down to 5%. But ultimately, you get a carve out, so you effectively take the globe income, you work out 5% of your employee cost, 5% of your fixed asset cost, you blend that number and you take that number off the 1,000, and let's assume that was a 200 number. I then have 800 left of what's called excess profit, and that 800 is what I apply the 3% to come up with the top-up tax number. So 800 times 3%, which I think is 24, would be the top-up tax number in that case.
And then kind of going back to how this is allocated amongst the various jurisdictions. So if these rules hold and it's January 1st, 2023, then either the ultimate parent company would then have to apply, that top-up tax, or an intermediary holding company would have to apply that. And if there's neither of those, then generally the rules wouldn't apply, or there wouldn't be an adjustment, right? But then as of January 1st, 2024, the UTPR kicks in. And then going back to my example with the UK and Germany, and then undertaxed in China, then that undertax payment in China would then get allocated between the UK and Germany, I think, right, based on their employees and intangible assets.
Yes, the pro rata. Again, you add up all the jurisdictions that have implemented the UTPR rule, they collectively, only jurisdictions that have implemented are included in that calculation, they collectively get the top-up tax allocated between them by a ratio that's partly made up of employees and partly made up of assets.
Yeah, and your point on the data and the calculation itself, which you've reminded me, is you're right, is not that complicated, right? But it's how do you get access to all of this data? And there may not, first of all, it may not even be an issue of whether you have access to the data. You may not have done have the data, the US GAAP kind of legal entity.
Yeah, I mean, it's not the same as, when we've looked at other modeling exercises around things like US tax reform, we've generally been able to say, well, we can model the impact of that by reference to the US tax return under the current rules and then adjust it for how the rules change. So there, the data is there to be mined, and then you've got to write the rules that change the calculation on the data. Here, there are two, I think, distinct processes. One is you've got to find the data in the first place, which I think in most companies will not exist in the form that's required in order to do the calculation. Now, you could obviously take assumptions, you could, try and take shortcuts, but at the end of the day, if you want to get a calculation that's going to stand up to scrutiny, and there is a filing requirement under these rules, albeit that's deferred out for a year and 18 months after the effective dates. But you're going to have to do that data gathering, which I think involves finding the source data and then applying a bunch of adjustments to that source data. And then you can run the calculation of, okay, now I've got the data, I can work out what my effective tax rate is, I can work out my substance-based carve-out, I can work out my top-up tax, and then I can work out how that is going to be collected and when that would be collected, either beginning 1 January 23 or beginning 1 January 24.
Yeah, the data collection exercise for this reminds me a little bit of the book minimum tax as far as looking at the book numbers. In other words, items that may not be readily available or otherwise computed. And there seems to be just a general view amongst taxing authorities, I guess the OECD to the US, that there just doesn't seem to be a lot of sympathy for multinationals about whether they have the data or not.
No, I mean, I think there is an assumption built into this. And remembering the rules only apply to companies or multinational groups that have greater than 750 million euros of revenue per annum.
Point. Mm-hmm.
So they apply to quotes unquote big companies. There's plenty of companies with 750 million of revenues that don't make a lot of profit, depending on what the margin in their business is,
Right.
who may not have the resources to do this. Even the very big companies that have the resources, it's still a huge compliance burden. You're effectively inventing a whole new set of books for every entity in your multinational group. That is a huge undertaking. And the book minimum tax in the US, I'm not going to pretend that I'm a supporter of the calculation or otherwise, but at least it's done on a consolidated basis.
Fair
it's not
enough.
done by an entity by entity basis.
Fair enough. You had mentioned, and I probably should have covered this earlier, that there are certain entities that are excluded from these rules. You had mentioned, first of all, you have to have 750 million euro total turnover. Your point is it has nothing to do with margin. So if you're in a very low margin business, that's total revenue.
Yeah.
And I think there are some other exclusions.
Yeah, I don't get your hopes up too much. I mean, governmental organisations are excluded, a governmental entity. So in certain jurisdictions, there are entities that carry on business that are quasi-government institutions that they're excluded, and not-for-profit organisations are excluded. Certain real estate investment trust, REIT sort of structures are excluded, and certain investment fund structures are excluded. Even those are limited by reference to, only certain kinds of those. So it's not a huge series of carve-outs. Now, one of the things that's up for discussion by the OECD Inclusive Framework this year is other carve-outs. And so there's some discussion around, can we find a way to define certain jurisdictions that should never be thought of as low effective tax rate, and how would you apply those filters with the hope that you can reduce the administrative burden? But I think that's going to be hard to do because they're very worried that jurisdictions can have low effective tax rates even with a high statutory rate.
Right. And to that point, I think a number of countries, and the reason I give the example of China is there are a number of countries that give incentives, right? And we also think about there's some special rules with respect to amortization, for example, so that I think what's important for our listeners to understand is I think that a lot of us came about this just thinking like, well, who's got a statutory rate lower than 15? And that's really not relevant.
No, I mean, this is, over the last 3 weeks, including over the Christmas break, I've had a number of conversations with companies who have unusual fact profiles, and those unusual fact profiles aren't inappropriate. They've been in a structure or a business or an industry where a government has decided to incentivize that business by reference to the fiscal policy of that jurisdiction to encourage that business, and everyone thought that was totally above board. Those incentives have largely been looked at by things like the EU Code of Conduct Group and the OECD Harmful Tax Practices Group, and everyone agrees they're appropriate incentives under those rules. Under these rules, to the extent they reduce the effective tax rate below 15, then those incentives are negated by the top-up tax. And I'm not sure that governments necessarily completely understand how far-reaching these rules are in undoing what I'm assuming they thought were sound government policy decisions to encourage investment.
Yeah, so what comes to mind is in developed countries, various types of IP incentives and IP regimes.
Patent boxes,
et cetera. And then for developing countries, they have given all kinds of incentives, particularly as we think about manufacturing in Asia and elsewhere. And this could be a significant detriment to those developing countries that are trying to attract foreign direct investment.
Yeah, I mean, again, the stated purpose of these rules is to level the playing field and stop tax incentives driving investment. Unfortunately, the stated objective of governments over the years has been to use tax incentives
Right.
to drive investment. So the two, at some point, have to have a culture clash.
Right. And I do wonder, kind of as an aside, like, will jurisdictions start to look at other non-tax types incentives? Because you can't, like, the competition for foreign direct investment is not going to stop.
I mean, that's clearly going to happen in some ways. It already is happening. I think Switzerland came out with an announcement today that they intend to raise the Swiss corporate rate to 15% in order to be compliant with these rules. Didn't exactly go into details of how the rest of the compliance was going to work and whether they were going to implement income inclusion rules and all those sorts of things, but just said we're going to raise the rate to 15%. But came with a footnote, said we will continue to consider further ways to make Swiss an attractive investment location. So, it's openly out there.
Right.
The OECD recognized that and actually said in one of their releases they will be policing the use of non-tax incentives. I'm not sure what that means, but they will be policing it.
Okay. So let's talk a little bit about, we've already referenced this a little bit about the U.S. Because we have a fork in the road here. And you had mentioned these Swiss proposals. It's mid-January for those that are listening. And at this point, there is still significant uncertainty about what's going to happen with U.S. tax reform, specifically the Build Back Better plan, and even more specifically, whether we may move to a GILTI country-by-country regime.
Yeah.
And so maybe talk a little bit about what does it mean for U.S. MNCs if we have country-by-country GILTI versus if we actually just keep with our existing blending regime?
So, I mean, I think, you've got to peel this back quite a long way in terms of the journey we've been on. So, think of it back to tax reform back in 2017. The US introduced GILTI, which by definition is a minimum tax regime. Now, that's what it was presented as to Congress. And we've had all the debates about whether expense allocation means it's not a minimum tax regime. But fundamentally, it was proposed as a minimum tax regime, but calculated on a totally blended basis. The OECD came along with Pillar 2 and wanted to design the minimum tax regime. And they came up with a design way back when, which largely is replicated in the model rules now, that a minimum tax regime should operate on a jurisdictional basis, not on a worldwide blending basis. And that's the framework for the rules now. Now, if you go back to last March, or even after that, the OECD messages publicly was that GILTI, in its current format, they would have to find a way to make it coexist with the Pillar 2 rules. The implication of that was that GILTI would be deemed to be an IIR-compliant regime, albeit it clearly isn't the same as the Pillar 2 calculation. And that was what I think most people were working on the theory of last March. Now, that's drifted quite significantly, and some of that, at some level is US-driven, where the current Treasury obviously wanted to move to country-by-country GILTI. I think as a starting point, they thought that the US GILTI rules should be country-by-country and not on a blended basis, and effectively said that's what our proposals are. So when you got to the Green Book and all the proposals from even Wyden's proposals, which wasn't country-by-country but effectively had the economic effect of country-by-country, the US proposals under Build Back Better, or whatever the predecessor for that was over the last 6 months, were all moving to a country-by-country basis. And some of Treasury and the administration's rhetoric was, we need to do that to make the US consistent with Pillar 2, which actually wasn't the message we were getting from the OECD back last March. But at whatever level, that's now moved on. And now we have a situation where it seems very likely that the OECD and the EU will not regard GILTI in its current format as an IIR-compliant regime. Now, the OECD have reserved commentary on that. The EU Directive, on the other hand, has language in it which sets out the criteria by which a regime could or could not be considered to be IIR-compliant. And it specifically calls out that anything that's blending above and beyond jurisdictional blending is not a compliant IIR. So the writing on the wall is, if the US doesn't change GILTI, then it's not an IIR compliant regime. What does that mean? That means that as of the 1st of January 2023, if you follow the OECD timetable, if the US owns its subsidiaries through an intermediate holding company in whole or in part, where that intermediate holding company jurisdiction has implemented an IIR. So for that, read, in theory, all of Europe, and in theory, the UK, at least by March of next year. Then, because the US has not implemented an IIR compliant regime, the intermediate holding company would get to apply their IIR compliant regime to levy top-up tax. And the US will have applied GILTI, but on a blended basis, there may be no top-up tax under GILTI because your rate blended was okay. But on a jurisdictional basis under Pillar 2, there could well be top-up tax, which you would not otherwise be paying other than the intermediate jurisdiction implementing those rules. That's 1 January 23, so that's not very far away.
No. Sounds like it, though, but it's less than 12 months.
It's less than 12 months, and, undoing structures and changing structures takes a lot of time, a lot of diligence. So I do think an immediate question for US multinationals is, what is your holding company structure, and where have you got jurisdictions that are likely to implement these rules by 1 January 23, and therefore will apply the rules in the absence of GILTI becoming an IIR compliant regime, and then roll that forward to 1 January 24 and say what happens then when I've got an undertax payment rule.
Yeah, and I know one of the other kind of technical issues that's out there is that the top-up tax, so let's say GILTI, we don't have country-by-country GILTI, we have a top-up tax. Well, whether the top-up, or we don't have the IIR compliant regime, whether any GILTI top-up tax, even in blending, whether the multinational would get credit, or like effectively the intermediary holding company would get credit for those GILTI taxes that are paid up at the U.S. parent. And really, I think it determines whether if it's a qualified CFC tax regime, I think is the terminology.
Yeah, I mean, it's a very complicated analysis. I mean, in order for taxes of the U.S. that have been levied on the foreign operations under GILTI to be creditable in that top-up tax regime, then the US GILTI regime needs to be deemed to be substantially similar to a CFC regime. Now, you might think that's a slam dunk, and one level of me says clearly it should be.
Right.
Even if you thought it was, there are huge complications of how you allocate that tax, because the US GILTI calculation being on a blended basis,
right,
with tested losses and QBI, how you'd allocate the tax to a specific jurisdiction would be difficult. But leaving that to one side, it's worth pointing out that a similar worded rule exists in the hybrid rules, whereby, if you've got a jurisdiction making a payment to a CFC of the US, which would be a hybrid rule, there's a rule in there that says you turn off that hybrid denial if it's been picked up by a CFC regime. And 2 jurisdictions have gone on record as saying they don't think GILTI is a CFC regime, those being Australia and the UK. So, it's not without any sort of controversy as to whether GILTI taxes would get pushed down if you were paying GILTI taxes.
So what about if the U.S., let's again kind of keep going down this road where there's no country-by-country GILTI and Build Back Better or whatever its successor does not get enacted? It's very possible that as a result of whether it is amortization in the U.S., the FDII income, other types of adjustments, whatever, that the U.S. book rate, if you will, or the U.S. rate may be below 15%. Yep. How does that work if the U.S. rate is potentially, if the U.S. effective rate for Globe is below 15?
Well, so that is kind of, that's almost without reference to the changes to GILTI, because whether GILTI is a compliant regime or not, GILTI never applies to the US profits.
Fair enough.
And never applies to branches or disregarded entities held directly by the US. So all of those profits i.e. the US consolidated group profits, including any flow-through profits from DEs or branches, are never covered by the GILTI regime, and therefore they're never covered by an IIR regime. So it doesn't really matter whether GILTI is compliant or not.
Got it.
What that means is, once undertax payment rules are brought in, if the US rate, for whatever reasons, having done this incredibly complicated calculation with adjustments to deferred taxes, stripping out general business credits, restricting deferred tax assets in a number of different ways, if that rate gets below 15%, then once the other jurisdictions implement undertax payment rules, the other jurisdictions will be allowed to apply a top-up tax on the US profits under the undertax payment rule. Now, there are proposals in the OECD paper to say you can resolve that by having a qualifying domestic top-up tax regime, which effectively says the country can apply a minimum tax on its own profits, and that would turn off the rule. And you might say, well, if Build Back Better passes, doesn't the book minimum tax do that? No. Right. I mean, it does something like that, but it doesn't do it in the same formula calculations as set out in Pillar 2. So you'd have to then get to the secondary debate as, well, does book minimum tax count as a qualifying domestic top-up tax regime? And of course, book minimum tax applies on a different set of filters.
Right.
Only very large companies are in the book minimum tax rules, so it won't protect everyone anyway. But even if you do apply a book minimum tax, it's not clear that that would turn off the undertax payment rule.
So let's continue down this road, as parade of horribles for U.S. MNCs if we do not have a Build Back Better, GILTI compliant regime. And I take your point that, you know, that issue for U.S. companies that have a below than 15% kind of globe effective rate are in the soup, whether or not we have a country by country. But we recently, also during the Christmas holiday, received another, a couple hundred pages of foreign tax credit finalized regulations. One of the things that is in there, and that will be the subject of next week's podcast, so we're not going to dive into any.
I'm not going to try and steal Wade's thunder next week.
Yeah. So we'll be certainly talking about that next week. But one of the really important points that dovetail with this is this concept that was in the proposed rules of jurisdictional nexus and now attribution.
Yeah.
And so generally those rules require for creditability now kind of a new standard for foreign tax creditability, that the taxes have to have what was referred to in the proposed jurisdictional nexus, now attribution to the country in which those taxes are levied. Going back to the example with the UK and Germany imposing tax on these China-related earnings, I think my initial thought is that, well, those would not be creditable taxes that may otherwise fall within the GILTI regime. But maybe talk a little bit about that if you've given any thought to that and the potential issue of really double and triple taxation.
Right. So, I mean, I think it's hard to answer the question until we see the actual mechanics of how the rules are applied.
Sure.
But, if you go to the wording of the finalized regs on what is a creditable tax, obviously there's a lot of changes in that area, and Wade will get into that obviously in more detail. But the one that worries us is jurisdictional nexus, which has now been redefined as attributable to. And, it's not clear, to me at least, that if you have the US owning an intermediate holdco which owns a bunch of CFCs, and the intermediate holdco applies an IIR, it's not entirely clear to me that tax can be attributed to the income from the jurisdiction that it's come from. It's a top-up tax. Right. It's a little like GILTI, but it's not exactly the same. So that's one question. Before you even get to obviously the more difficult question, in your example of China, UK and Germany, it's very hard to see how, if UK is levying tax on the undertaxed income of China, how the UK tax is jurisdictionally related to the UK activities, when clearly it's not. It's related to the China activities. And so those foreign tax credit rules, when you start applying them to how Pillar 2 is meant to be mechanically working, give a very real concern that if the foreign tax credit rules are finalized, they are, and they're not changed to reflect this new world order, and then we have these top-up taxes being applied by other jurisdictions other than the US, that those taxes, which will be real taxes, will not be credible from a US FTC perspective. So you could very easily get to a scenario where you're calculating the top-up tax under the Pillar 2 principles, you're going to pay more foreign tax, but you're still going to have a GILTI top-up tax under the current GILTI regime because you won't get credits for those taxes. Now, that's less of a concern in a blended GILTI world, a worldwide blended GILTI world, but it's still a concern. There are still a lot of US companies who are paying a top-up tax under current GILTI rules who would not take kindly to the fact that their foreign tax burden has gone up, but somehow their creditable tax base for US GILTI purposes has not gone up because you don't get those credits. I think that's a very real concern.
Yeah. Do you have any hope at all, Calum, that if Congress is unable to pass corporate tax reform, unable to get to a country by country, that if Treasury would come in and potentially make a mandatory high tax exception, for example, so everything that's at or above 15%, they say is kind of is kicked out of GILTI, and that it's only low tax GILTI, is there that would then be included, but you're still blending, but you're blending everything below, let's say, the 15% rate. Yeah. Is there any hope that that could be considered IIR compliant and try to avoid some of the soup that we may be in if it's not?
I mean, I think if you start from a position of logic, rational, and sanity, you can clearly see how someone should be persuaded that if you're blending across jurisdictions, but the only blending that's going on is amongst jurisdictions that have less than 15% in the first place, then you're not effectively blending credits to reduce a tax burden. Mm-hmm. You're just blending for an ease of a calculation, to be honest. And therefore, the top-up tax economically should give you the same answer, leaving to one side that the GILTI inclusion definition is based off US tax principles and Pillar 2 is based off financial statement principles, so the base is a different number anyway, but the tax number in that scenario should be the same. The difficulty is going to be, by the time Treasury gets to that, if they get to that, in the absence of Build Back Better, then probably the OECD may well have written their rules. The EU may well have actually agreed a directive. And then you're having to deal with each jurisdiction saying, we've made this change, we'll explain it to you, now can you confirm that GILTI is an IIR compliant regime? Mm-hmm. I think there's a timing issue here. I completely buy the rational policy debate there. Leave to one side whether we think any of this comes out of rational policy debate in the first place, but leaving that to one side, you can get the economics to say that makes sense. The question is, how do you get people to change from whatever framework of rules they've written? Because if they've written something that says anything that is above jurisdictional blending is by definition not an IIR compliant regime, then your proposal is still not an IIR compliant regime.
So maybe
I don't know.
Yeah.
I mean,
so we'll see. Yeah. Your timing point is a good one, just in how quickly. Let's see what happens with Build Back Better, what Treasury would try to counteract if they can't get it. But so maybe here in conclusion,
maybe that's the other point, which is, at one level, Build Back Better either coming to pass or being clear that it's not coming to pass as quickly as possible would help define the approach to the rest of the world. But for as long as it's a debate as to whether we're going to get it or not, then you can't really enter into a debate with the rest of the world as to what to do with the rules.
Right. So here in conclusion, because we're at time, what should companies be doing now?
Well, I think, the obvious answer at one level is go away, look at your numbers, start trying to do these calculations.
Model. It's a constant theme.
It's going to be model. There are, I think, things that companies should think about trying to sort out with their structure before the potential effective date of the end of this year. not necessarily to try and get around the rules, but to ensure you don't end up with double taxation under these rules. I think at one level, that's the primary objective here, is not necessarily to say we found a magic way to make these rules not apply to us, because the construct of the OECD framework is very cleverly designed to ensure that actually it's very hard to structure yourself out of the rules. You can't go to a jurisdiction as your ultimate parent entity just because it hasn't got an IIR and say the rules aren't going to apply to me because of the undertax payment rules. So they've really, the backstop is well designed from that perspective. So I think it's really about making sure you haven't got footfalls in your structure, knowing where your low tax entities are, making sure you can clean up the balance sheets as necessary, deferred tax assets, etc. There's some challenges around brought forward losses that you need to think through. There's some challenges around brought forward foreign tax credits you need to think through. So there's a whole bunch of, a list of things that need to be thought of, but it's hard to do that list without actually, first of all, trying to get to what are the numbers. And, you know, so far I found it somewhat surprising how many, what you would think of as not low tax jurisdictions end up being, you know, either on the margin or actually low taxed, having applied these various calculations.
Right. And to go back to the model point, like once you try to actually start doing the model, you realize that you don't have the appropriate data, and it goes back to everything that we had discussed a little bit earlier.
Right.
So,
yeah.
Well, Calum, always an insightful discussion. I wish I would bring you on to talk about maybe rosier topics, but significant dark clouds coming in, and the point on double and triple taxation, I think, is obviously the most concerning for me as a practitioner, and something we'll keep an eye on, particularly as we study more of the foreign tax credit rules, and then we understand how the proposals actually layer in to that. So
Okay.
Thanks for joining.
No problem.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Calum Dewar, PwC's Integrated Global Structuring Leader. I'm Doug McConey, PwC's International Tax Services Leader. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.